Alrighty, we're going to move on to the markets and how they're basically responding. Quite honestly, it's mostly to the Fed, the Fed press conference from yesterday and the Fed reports. It's not that much with the GDP. So anyway, I was looking at this last night. Thought I'd throw this up here this morning. I put together a 1 hour, an hourly chart of the S&P 500 going back to December. Try not to move this too much. So we have up at the top, we have the first technical indicators, the RSI. That would be the 14-day RSI. It first came out from Wells Wilder. And that's my favorite technical tool. And I prefer a nice clean chart. And as you can see, this is a very muddied up chart. But anyways, I muddied it up with on-balance volume, but for good reason, because it shows some stuff. First off, a couple things to notice on the hourly chart. We're definitely overbought, or we were overbought at the 70 mark, and we're kind of pulling back a little bit. And then if you take a look at the chart itself, moving down just a little bit, you can see the on-balance volume. So I overlaid on-balance volume over the S&P, and I will overlay it here in just a moment, but I wanted you to be able to see this because what you're seeing is a very thin market, and you're seeing a thin traded summertime market where you've got a lot of short-term buyers that have come into the market, and you can see the moving higher. This is the unbalanced volume line, and down here at the bottom, yes, it's budged. The S&P is up a little bit, budged the Dow and such. And you have a counter trend rally going back to the lows back in mid-June. But that's all it really looks like, is just a counter trend rally. So not all that much, in my opinion, to get excited about. Let me take the unbalanced volume off. Let's go down here and take that off. So we can take a look at a clean chart, because this really does look pretty ugly. And let's take the volume off also. I'd rather look at a clean chart here. And here we go. Now we also have some Fibonacci retracements. The reason I went back to the highs in December and January was to be able to capture that peak. And we have a full leg down going from December, well, technically in the S&P early January, through the mid-June period down at 36.87, and a 38% retracement of that would take you back to 40.86.99, which we have not quite gotten to yet. So for all the hullabaloo that's going on, we have closed the gaps that's over here on the left from early June, this last leg down, which you can see. But other than that, it's a very ordinary, kind of weak looking counter trend rally, and for very good reason. There's really not a lot looking forward, in my opinion, from a big picture standpoint, that is particularly positive. You certainly don't have a lot of positive stuff going on with the Fed. They continue to raise rates. That has to filter through the system. I think the one positive takeaway, and it's a very nuanced positive, is that, I think some of the traders were looking at the Fed statement thinking, well, maybe they're not going to be so tough on inflation going forward because they're going to tilt more towards trying to, the Fed is trying to thread a needle, and they're not going to be able to do it, of reversing Fed policy and simultaneously avoiding a recession. It's not going to happen. You have to choose one or the other, and ultimately, we'll see which direction the Fed goes in. But that's the response we're getting in the markets, especially yesterday, was really some hope that the Fed is going to ease sooner than they've been advertising. So we'll see what happens. But you can see from a longer term perspective, we haven't even made a 38% retracement. We might not. I mean, we've basically done what I was expecting, which is to close the gap. You can see here going back to June, you can see these gaps. And the one thing technical analysts have been looking for has been, we're going to fill that gap. Well, it's filled. Okay, so we filled that gap. Do we then move just a bit higher to a 38% retracement or even a 50% retracement? It's possible. It's definitely possible, but we're running on borrowed time right now, and I don't think there's any question about that. Anyway, well, let's move on.